Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. Okay, so for many weeks and months, 32 weeks in fact, I've started here with my longer term monthly charts as the market since as far back as the lows seen in August 2024 till October 2025 built a sideways action. I first noticed this action 62 weeks ago, just over a year now, and this sideways action had a breach on the upside in October last year and a second and more serious breach in January this year. Through March and now April and into May, prices have now consistently closed over and stabilized over the 3-year moving average, which is not shown on this chart, but it's at 1139.25. However, the key feature which I wanted to make you aware of is the bright red neckline, which is currently at 1216, which you can see redrawn here on my daily chart, a little above the current market. This bright red neckline has been pierced, but not as yet broken, not properly broken, and is the key to the longer term action here in this market. Monthly consecutive closes over this bright red neckline will see the termination of a huge November 20 to January 2024 head and shoulders top pattern with all the subsequent consequences, especially on the downside, or should I say the failure to push on the downside. This is something to keep in mind as we go forward. So coming back to the very recent action, this has seen a small bright green rising wedge pattern, 1187.25 to 1212 currently, formed over April from an earlier sideways action, had an even earlier exiting a small bull channel. We have seen prices try on the upside twice within the last 2 weeks, but as we've seen yesterday and again today, we've failed to stabilize over it as prices are today once more again back, well, not even back within it, but back below the bright green rising wedge pattern and below the and that lower bright green trend line is now being compromised if we should close down here. We didn't close yesterday, but we might close today. I originally saw the chance that this pattern could morph into an early April to date based bull channel, currently 1187 to 1236.5, as the lower trend line looked good as it is aided by the rising green short medium moving average, currently at 1189.25. But that may be changing now, and we will see if the formation around the support around the 2021 low at 1181, well, if that congestion formed between March and April, which is rotating around that 2021 low, we'll see if that's any good. Meanwhile, the upper trend line is at best diaphanous, with the previous mentioned bright red neckline mixing with it, and as well as the 50% Fibonacci line of the April 20 to August 24 move at 1222 and a December 21 low at 1223.25. So we should have had some pretty good looking support below right now, which is now not looking that great, and some potentially good resistance above that is not as strong right now either. Please just bear in mind that all this action has prompted by the weekly key reversal up seen 5 weeks ago, and should be on the watch out for the market to set a possible weekly key reversal this week. We haven't done it yet, but we're very close to it. And if so, a likely weekly key reversal down it may be. Then we have the big picture, the bigger picture actually, and in this prices are still well within the dark blue December 24 to August 25 bullish Andrews pitch rule, in between the dark blue middle time above, which is currently at 1249.25, and the dark blue lower time below, currently 1130.5. This is the key pattern that has been driving prices higher here since August last year, and it's still doing it right now. Chicago soybean meal. The market continues moving up nicely within the bright red late September 25 to mid-January 26 bullish shift pitchfork, specifically between the bright red lower time below, currently at 315.5, and the overhead bright red middle time, currently at 342.20. This middle time has been especially good at capping prices since late February. A little below this pattern we have the significant dark blue trendline extension, currently 311.40, of the July to September 2021 descending triangle, which had acted as an attractor and then later as a base for the moves higher. Now, we also had the 50% Fibonacci line, the May 24 to July 25 move at 326.20, originally capping prices but now acting as a support. This is, well, it was a temporary support. It seems to be back below it at the moment, but we'll see how that closes out for the end of the day. This is where what was a word of caution, but which is now an observation, I suppose, is worth repeating. I said 8 weeks ago, and I quote, should prices turn back up, especially if we start closing over the 50% Fibonacci line, then the next choice will be the bright red middle time. But a word of caution. You see, the bright red middle time is now awfully close to the 2025 high at 333.5, and they together may be a stronger resistance than each individually. I suspect any reversal back upwards will very much depend on maintaining what we have seen since the beginning of this year, with the low in early to mid-January. We have so far had rising lows, a very definitive bullish sign, and that depends on the market not pushing down below 308.90. End of quote. Indeed, that's a bit of a long quote. Indeed, what we have seen since the start of this year, bar one single aberration, is the market caught between the bright red lower time below and the bright red middle time overhead. So now we'll continue to watch this impromptu bull channel develop, especially as prices are now testing, were testing a potentially significant resistance yesterday at the 61.8% absolute Fibonacci line at 336.30. And this leads me to my final point and a word of caution. This commentary would not be complete without my discussing a portion of my commentary which I've repeated for 154 weeks. So coming up now for 3 years. It is the annual key reversal seen here at the end of 2023. I said back then, and I quote, I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023 and been living in the shadow of this pattern ever since. End of quote. I have also added ever since, and I quote, if there is only one thing you take away from any of my musings, let have been those words. End of quote. Nearly 3 years, the shadow of that pattern has darkened the skyline of this market ever since. I'm starting to wonder if prices now finally exercising that shadow, but please bear in mind, we are still significantly below the close of 2023. Chicago soybean oil. There's one pattern here that has defined moves higher this year, but is now being tested. It's the bright pink March to August 2025 bullish Andrews pitchfork. The bright pink upper time currently at 73.88, capping the market most of the time, and now at the moment as well, with a close yesterday right on it. We've broken up through this pink upper time 2 weeks ago, but then this week, today even, we're back below it significantly once again. This break higher, possibly now also only a breach, not a break possibly, but a breach higher, prompted me to draw a new mid-March to mid-April bullish Andrews pitchfork. This also saw a breach higher last week, though I note prices have also pulled back within this pattern and actually moving towards the lower time of this pattern. And also, we're down through the middle time. That move below the middle time, which is 74.09, is especially noteworthy. This leads me to something I spoke about 2 weeks ago, when I said, and I quote, what is noteworthy is that we saw the development of an ascending triangle over March and April, but which has now turned out to, it seems, to be a bullish halfway hesitation. Last week, so that is actually 3 weeks ago, last week prices broke up through what seems to be the top of the hesitation, part of the halfway hesitation, specifically the congestion between 68.71 to 69.12, and make the March action into a hesitation part of a very large bullish halfway hesitation. This leaves us now excluding the idea of an ascending triangle pattern with a few distinct possibilities for the bullish halfway hesitation. Thus, if we measure from the start of February low, then we have a primary target X up in the 75.40 area, so not too far above, and a harder to reach secondary target X1 up in the 82.10 area. If, however, we measure from the deeper December 25 low, then we have a primary target X2 up in the 78.45 area, and a harder to reach, much harder to reach target X3 up in the 87.20 area. I'll be interested to see how the market deals with these potential targets. End of quote. Well, last week prices reached the first, and let's be honest, easy target X at 75.40, but it still leaves targets X1, X2 and X3 open. I think for this market the question once again is not whether the market is bullish, but how bullish is this market? How very bullish is this market? Is it just mildly bullish or very bullish? Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.